it easier on everybody, we'll stop for a second, let you get some photographs, and then we'll that work?
Good afternoon, everyone. I'm Elizabeth Stouderman. I'm the Chief Communications Officer at Yale University, and I want to thank you all for coming to this momentous occasion to introduce Yale's most recent Nobel laureate, Robert Shiller, Sterling Professor of Economics and Professor of Finance. You'll find press materials regarding this and the other announcements that we make on our website. We encourage you to go to news.yale.edu for updates about everything that happens at Yale. You can also contact my colleague, Amy Athey McDonald, who's raising her hand right now, if you have any requests for one-on-one interviews with Professor Shiller, who is, as you can imagine, a very popular man this morning. The way that we'll make this press conference go is that you will first hear from the Chair of Economics, Douglas and Marion Campbell, Professor of Economics and Computer Science, Dirk Bergman. Professor Bergman will introduce Dean Ted Snyder of the Yale School of Management, and Ted Snyder will introduce President Peter Salovey, and Peter Salovey will introduce Professor Shiller. And we ask that you hold your questions until after the presentations have been made. And also, if you could speak your questions loudly so that we can hear it, this event is being live streamed. Thank you very much for coming.
Thank you. Well, as chair of the Department of Economics, it's of course my great pleasure to welcoming you all to join us in celebrating the reception and the Nobel Prize for Bob Shiller today. Bob has been a member of the Department of Economics since 1982, and today he was awarded a Nobel Prize for his work in the analysis of empirical asset pricing, jointly together with Eugene Farmer and Lars Peter Hansen from the University of Chicago. As it was said, Bob Shiller is currently the Sterling Professor of Economics at Yale. This is the highest academic rank that Yale University awards to its professors and has been with us since 1982. Bob received his BA from the University of Michigan in 1967 and his PhD in 1972 from MIT, already with a dissertation topic on asset pricing, namely entitled Rational Expectations and the Structure of Interest Rates. And that was under the dissertation of Franco Modigliani, as well a Nobel Prize winner. For me, the range of Bob's work is really astounding and with an incredible reach over many fields and research methodologies, and he doesn't rest in that aspect. And already his list of publications is sort of a small book by itself. Let me just mention among his earlier contributions that made really a lasting mark is the paper that starts with a question: do stock prices move too much to be justified by subsequent changes in dividends? Now, it sounds like a rather technical but yet fundamental questions, to the entire class of our basic understanding of financial markets and asset pricing. And this paper, which was published in 1981 in the American Economic Review, really led slowly but very surely to a turn in our understanding of financial markets, and in particular to behavioral turn in financial markets, and it still has a lasting impression. And you will see his academic work really went on and on, but from my point of view, what is the most impressive is how he translates his deep theoretical understandings in markets, in economics, in then to an understanding of how can we create instruments, policies that really have the scope and the potential to improve society's welfare. So just to give you one of the more prominent examples, and this is really rare for an economist, so it's even more distinct in that sense. In 1991, Bob created, with his colleague Carl Case, an index for house prices that was developed further and then actually implemented, and is now quoted and cited daily by Standard & Poor's and Fiserv's, that was simply meant to capture the evolution of house prices. But that was, of course, just the basic idea to start something much larger that he expanded in a beautiful book, which was called Macro Markets, Creating Institutions for Managing Society's Largest Economic Risks, that really developed the theme of how we can find instruments to diversify and insure a large swath of the population against many of the risks that they're actually uninsured. So in that sense, it is really academic work that had the deepest reach into our ability to actually develop policies that can help the citizens in the US, but globally, of course. And he continues to propose new methods to risk management, which are not only helpful for Wall Street, but really are helpful for Main Street, if you want me to say it in that way. Okay. This line of work has been very influential, and of course it also makes him a very popular teacher at Yale. He teaches many classes at Yale, a very popular class, an introduction to financial markets, and this year an introduction to macroeconomics, which will be attended by our freshmen and sophomores. And so that just shows you the fascination that Bob can also invoke as a teacher of his research. And probably he will have even more students now in the upcoming semester. I should also say that he was one of the earliest teachers to develop Yale open course material, and particularly his course on financial markets, and he's going to develop a new course on Coursera in the spring that will be already subscribed to by several 100,000 students. So it's really an amazing influence and reach. And so my hope is that this line of work, which was very influential, but will become even more impactful with this award of the prize to Bob, and so that his insights will really help us at large to develop better means to ensure and develop global goods. So thank you, and it's my great pleasure to have Bob here among us today. Ted Snyder, the Dean of the Business School, will say a few words about Bob as well.
Thank you. All right. Professor Bergerman, thank you very much. I thought your comments were most insightful. President Salovey, Professor Shiller, it's really a wonderful honor for me to be here. It's quite an amazing day for Yale and for Chicago. And just on a personal note, I have the great honor of knowing all three laureates, having been dean at the business school at Chicago prior to my appointment to Yale just 2 years ago. And I'm very happy for Lars Hansen, my former neighbor, and for my very dear colleague, Jean Fama. It's really an exciting day for all three recipients. And I'm also mindful of the fact that there was a guy sitting in the back of Jean Fama's class, David Booth, who decades ago listened to Jean and implemented his ideas. And I'm sure David is very pleased today. But today here at Yale is about Bob Shiller, and I'd like to just add to Professor Bergerman's comments. And it's interesting, he and I didn't coordinate, but it just shows you that it's quite clear. Bob Shiller is the leader of, and indeed the founder of the field of behavioral finance. That's the consensus view. And it starts with the paper cited already, the 1981 American Economic Review paper. And I'll state the question a little bit differently, but I think it's worth stating, and it's a very important fundamental question. When we look at a stock price, what does it depend on? And a lot of people said that the stock price depended on what profits the firm was expected to earn over time, and then how those profits would be discounted. And then if in fact stock prices depended on those factors, then changes in stock prices would necessarily reflect changes in the expected profits or the discounting. Well, this was the tenet. This was the belief. But it was Bob Shiller who said, well, let's test it. Let's see if it's true. And let's look at actual stock price movements and see if they, in fact, are explained by this formula, this relationship. And what he found was stock prices change much more so than what you could explain by changes in profits or changes in the discounting mechanism. That began the field of behavioral economics. And his intellectual leadership in this field has had a profound effect on the academic world. It's had a profound effect on the world of practice. And we at the Yale School of Management, where he has a joint appointment, have benefited greatly. And as dean, I'm mindful that he has indeed had a profound impact on our school. And I'd just like to identify a few of those contributions. Professor Shiller co-leads with Professor Nick Barbaras the Yale PhD summer camp on behavioral finance. He's an active member of the Yale School of Management's International Finance Center. He has been collecting and analyzing data on investor expectations over the long term. It's a project financed and supported by White Box Advisors. When his most recent book came out, Finance and the Good Society, I met with Professor Shiller, and he agreed to give a series of Yale School of Management lectures on the book. He is in great demand, and of course will now be in yet greater demand in terms of various audiences for the school, students, alumni, friends. And what's really nice is that he's been very generous with his time to all those audiences. On January 11th, he'll be part of an opening conference at the Yale School of Management when we open our new campus, Evans Hall. And the topic will be Finance and Society, Markets and Behaviors. He'll be joined by David Swenson, Chief Investment Officer for Yale, Jane Mendello, Chief Investment Officer for Harvard, Will Getzman, our colleague in finance, and Ziwu Chen, also our colleague in finance. I thought you did a great job in covering the role of the Case-Shiller Index. I won't repeat that. It's noteworthy that both Professor Fama and Professor Shiller have generated a lot of very practical, empirical work. This is unusual for academics, and I think it's great testimony to each of them. And if we didn't have the Case-Shiller Index, we probably wouldn't have anywhere near as much insight as we have now into the question of financial crises and the potential for bubbles. The last thing I want to do is say sort of a shout out to all the MBAs, Yale MBAs, who had the great fortune of taking the course offered throughout the university that Bob has offered, behavioral and institutional economics. A lot of very smart Yale MBAs were astute enough to say, let's go over and take Bob Shiller's class. Thank you. And now, President Peter Salovey.
Thank you, Dean Snyder. Thank you all for being here. I know you want to hear from our laureate, so I will be brief. You know, I have to thank the prize committee, but especially Professor Shiller, because it's not every day that the Yale president is able to stand before the press and say, I'd like to announce today and introduce you to a Nobel laureate from Yale. It's not every day we can do that. It's just every Monday that we can do that. So thank you, Dirk, for those comments. Thank you, Ted, for yours. This is a great day for our university. And I am delighted that in 1 week's time, we are able to stand on two sides of campus, on the medical school side of our campus, celebrating the award of the Nobel Prize in Physiology or Medicine to Professor Jim Rothman, the chair of our cell biology department, and then today to be able to celebrate with our friend and colleague Bob Shiller, Sterling Professor of Economics and Professor of Finance, on the announcement of his receipt of the Nobel Prize in Economics. We also have other aspects of the economics world that we will be able to celebrate this year, this week, that connect to Yale. For example, the announcement of Janet Yellen, who is a distinguished graduate of our Department of Economics as the nominee to head the Federal Reserve. This is really all very exciting to me. 2 Nobel Prizes, Janet Yellen, and of course this was the week in which I was formally inaugurated as Yale's 23rd president, and for me to be able to celebrate with such distinguished colleagues and really celebrate their achievements is as exciting for a new president, I think, as anything that could have happened on this campus. You know, I have to say, although Bob's home department is economics, and although he teaches and has an appointment in our School of Management, I must say that Professor Shiller's approach includes ideas from my own field, social psychology. And in fact, the field of behavioral finance, and now more generally behavioral economics, really is one of a merging of 2 underlying disciplines. Work in social psychology, particularly in a sub-area called judgment and decision-making, merging with and influencing traditional economic models to suggest variables that need to be attended to if we are really to have a true understanding of bubbles, of collapses, of other economic phenomenon. Economic phenomenon is, at the end of the day, at least from this psychologist's perspective, driven by human behavior. And it is Bob Shiller who has made all of us, whether it's in economics and finance or in psychology, more and more aware of this. So his work is really quite synthetic and quite cross-disciplinary in its approach. Now, the other thing I have to mention that Professor Shiller shares with Professor Rothman, as our 2 Nobel laureates in a week's time, is that in addition to being incredible scholars and researchers in their own field, both of them are incredible teachers. As you've heard from Professor Bergman, Professor Shiller is teaching the introductory microeconomics course this spring. He will probably have 350 students. At least that was our estimate before today's events. And to imagine you are an undergraduate at Yale, probably a freshman or a sophomore, and you are taking macroeconomics, a course that sometimes has perplexed freshmen and sophomores, and you are taking it now from a Nobel Prize winner. Nothing could be more exciting, I think, in a student's life, and nothing could represent what we are trying to accomplish here at Yale University in suggesting that brilliant, world-leading research and excellence in teaching are not opposite sides of a coin, but actually can be conducted together. I have to mention that Professor Shiller also is offering a course to the general public through Coursera that is entirely free and will begin in January 2014, although you can register for it right now. And this is a course in financial markets that I'm sure will be excellent. Well, I know that you all want to meet our Nobel Prize winner. I know many of you know him, especially from his book, Irrational Exuberance, but maybe from many others. I know that he has been a force in educating both the scholar, the student, and the layperson alike about finance and about the human behavior that gives rise to interesting financial phenomena. And so let me not delay any longer and introduce to you our latest Nobel Prize winner, this time in economics, Professor Robert Shiller.
Well, I'm still in disbelief. I'm certainly honored by this event. I'm starting to wonder how I'm going to live up to the expectations that people now have of me. So yes, it's correct. I'm going to be teaching the intro macroeconomics course here next semester, and populated heavily by freshmen. The problem is, our chairman, Dirk, told me that freshmen tend to be very critical of their professors, especially in these big classes with hundreds of students. So I'm viewing that as a challenge. So yeah, I have a certain disbelief. Maybe it's because of a habit of thought that I tend to think of my own work as a minor addendum to a huge body of work that others have generated. And so I had the idea that I would list my co-authors. There's only 22 of them. I went through my vita, and I think if I missed one, I'll be horrified. But George Akerlof, Stefano Athanasoulis, Andrea Beltrati. By the way, this list, you'll note how international. These people are all over the planet now. Maxime Boyko, Oliver Bunn, John Campbell, Carl Case, Ray Fair, he's here at Yale, Sanford Grossman, Jiman Jung, Fumiko Konya, Vladimir Korobov, Randall Krosner, Franco Modigliani, Pierre Perron, John Pound, John Quigley, Kim Schoenholtz, Jeremy Siegel, Yoshiro Tsutsui, Eric Van Winkoop, and Alan Weiss. That's 22 co-authors. I want to thank them on this occasion because they contributed to my work. But it's not just my co-authors, it's also all the other people in our department and in other departments that I've worked with, including, I might add, the co-Nobel Prize winners. I was going to send them a congratulation this morning. It was just too hectic, but I'm going to. And I'm thinking that their work might seem different from mine. As Dirk was saying, I've been involved with behavioral economics and behavioral finance, which is more psychologically oriented. But on the other side of it, I've always been a lover of mathematics and theory that represents a different approach to economics. And I think if you were to compare my work with Gene Fama's or Lars Hansen, look at them side by side, you'd see a lot of similarities as well. I'm interested in the same mathematical concepts. And Lars Hansen was testing some of the same models, which are rational models, and by the way, he rejected them. So he didn't come around saying you were right about behavior, but he did reject the models. So Peter Salovey pointed out that I have been more involved in interdepartmental efforts. Not that I show up regularly at all these other departments, but I was thinking that psychology has had a huge impact, partly because of my wife, Ginny, who is seated there, who is a psychologist at the Yale Child Studies Center, and I talk with her more than any other person. And I'm sure she has shaped my work in a fundamental way. But I'm thinking it's not just the psychology department. The management school represents a intellectual. I think that there's many different intellectual approaches to the basic questions that people want to know answered. People develop certain ways of thinking about them. So the management school, for example, has a marketing department, which is almost a second psychology department, but with a different focus. And then there are other departments in the university, the sociology department. I used to ask, maybe Peter can explain, what's the difference between sociology and social psychology? I think I have an idea, but it's deep in the motivations and the habits of research that differ. Then there's the political science department, there's the history department, there's the statistics department, and the law school, which I like also to mention. I really have, over the years, grown an increasing appreciation for our law school and law in general. It's a discipline which I think is closely related to economics, but is very real world, very real world oriented. And then there are other departments too that fade away in relevance to what I do, but still are relevant. So that's the thing I wanted to express my appreciation to all these people. So I've been involved particularly in a movement called behavioral economics. And I've been organizing workshops with George Akerlof and with Richard Thaler for 20 years now. But I don't mean to be doctrinaire about that. It's not another cult. I don't believe in schools of thought. I think it's all approaches that have their unique advantages, and we want to try to learn from all of them. I should say something about Yale. I was attracted to this department over 30 years ago. What was it? It was the kind of intellectual breadth and depth that I saw here. James Tobin was among the people who particularly impressed me. And not just for intellectual depth, but it's for morality. I thought Tobin and others here were particularly moral people. It's a matter of getting your real values integrated with your research. I think it's significant that Janet Yellen, who was just nominated by President Obama for the Fed chair, is also a very moral person, I believe, and she did her dissertation under Tobin. So I can see a line of dissent for these attitudes. So I thought I would just say a couple more words about finance and the field. The prize for all three of us this year was in asset markets, which is a branch of finance. I think that finance it's often misunderstood as a field about how to make money, how to get rich. I have to tell my students here that's not how I think of it. Finance is the study of human activity at large. Just about any useful thing that we would like to get done involves groups of people, and it involves time. It's an activity that has to be consistently pursued over years of time. People will come and go. Well, this is management, but it's also finance. Finance is about well, financing activities. That means making the resources available, incentivizing people, spreading the risks. Any useful thing is likely to have risks. And that's what I think we are about here. In particular, I think that we have important risks and problems going forward that improvement in our financial institutions can help solve. I'll mention, first of all, it's not the financial crisis per se, but the most important problem that we are facing now today, I think, is rising inequality in the United States and elsewhere in the world. This is a problem that has solutions. Many of them are financial solutions. Finance is substantially about risk management, and if it's applied right, if it's democratized, that means if the real tools are made useful to real people and not to just a minority of people, it can help solve these problems. I'll stop with that, and then we have open for questions.
So we invite your questions.
The shutdown and the deficit. Well, this is a political science question, I guess. Sometimes people ask me, what do you think the effects on financial markets will be? But let me first say, in deference to our law professor, you should really be asking an expert in constitutional law, because the particular crisis transcends the immediate. It's about how we're going to do things in Congress. How will the government reach consensus? I'll defer to others on that very important question. I hate to do this. I like to go to the essence of your question, but I feel in this case I could instead comment on what it will do to financial markets. And I'm thinking probably nothing big is going to happen. It should be okay. That's partly a political science. This is how you can't divide things up. It's my sense that we still have in this country a sense of cooperation that will emerge and prevent a default. But I can think about what happened. We've been through this before, notably in 2011. Remember, it was August 2 of 2011 that was targeted as a date when we would run out of money and default. And then on the very eve of default, Congress finally came through, and we did not default that time. Then, however, on August 5th, Friday of 2011, after the markets closed, Standard & Poor's did an unprecedented step of downgrading the U.S. debt away from AAA status. That following Monday, the stock market, S&P 500, fell 7% in one day. It looked like, and there was a lot of noise around it. It's a strange event because leading up to this crisis, the market was, before August 2, was rather quiet. Then it's after the downgrade that it got wild. So what happened? Well, I think that the downgrade shook the sense of confidence of Americans in their own institutions. It was a shock to think that we're not a AAA country anymore. On the other hand, the market has gone up a lot since then, and so even that wasn't so fundamental. So that's why I'm thinking that this crisis will likely be resolved. We won't see a default. Even if we do, it will be for one day or something like that. And even if it's longer, I think that it's not the end of the world, and the markets might drop 7% on some day and then come back up. I should add, however, I do not know the future, and I could be wrong.
Professor, I did read an article this morning talking essentially about that and saying that if the markets have problems that over the next 48 hours, that will push lawmakers to finally make a deal. What does that say about your work? Is that kind of
Yeah.
speak to what you always talk about?
Yeah, the thing is that there is a unity of knowledge that there's so many factors that affect the stock market that people don't think about. The stock market is deeply political. You have to remember that we have, for example, a corporate profits tax, and Congress raises and lowers that. It's been up and down. When they raise the tax to something like 50%, that's like nationalizing half the stock market. And then when they cut it again, it's reversed that. And it's not just the corporate profits tax. There's so many things the government does. So I think that's one reason why the market is probably less unstable than it would seem based on some theories that exclude political science. If you remember that our congressmen are interested in the confidence that Americans feel and do not want to see crises in the financial markets, we can expect them to do something that's more stabilizing. The problem is in answering questions about such deep and important questions, it brings you across all of the different fields of social science and beyond.
Can you talk about your legacy of, I guess, breaking down complex economic theories in a way that everyday people can understand, particularly with the housing market?
Well, I've been writing what are called popular books or trade books. I like to call them scholarly trade books. It's not a question just of speaking to the general public. I think if one writes well, it can often be accessible to the general public. But the kind of popular books that I've tried to write are big picture type books that put it together in a way that that you couldn't get by reading scholarly articles. So in some sense, they're summaries of what people are doing, but I don't feel that they're just a summary. I feel that a well-written trade book, scholarly trade book, is something that ties different things together in an intuitive way, presents a world view, and something you wouldn't do to a professional, to a scholar, you can do for the public and hope that the scholar reads it anyway. So I was giving an example at a talk I gave last week in Princeton about how people don't connect things they know. So I was with Ginny on Clam Island where we were watching, out in the Long Island Sound, where we were watching a sunset. And I was asking, with various other people, and I stopped to ask them, do you know what you're watching here? What is this phenomenon, a sunset? And they looked puzzled. What do you mean? I said, well, do you reflect for a moment that we are moving backwards at 600 miles an hour as the Earth turns, and we're losing sight of a 1,000,000-mile in diameter ball, and that, oh, on top of that, the Earth is plunging down that way at 66,000 miles an hour in its orbit around the sun. I don't think they knew that, right? I mean, they know that intellectually, but they don't integrate it into their thinking. That's partly what I do to answer your question in writing a popular book. Yeah? Well, I'm not the first one to raise this issue, that inequality has been getting worse for decades, economic inequality. And it could get much worse. We don't know. Maybe it'll just correct itself, but these are hard things to forecast. But I'm reminded of the MIT mathematician Norbert Wiener, who in the late 1940s wrote one of the first books on computer science. The title of the book was Cybernetics. And it was a very mathematical, technical treatise on computers. But in the last chapter of the book, he had some philosophical thoughts. And he said that he's worried about the computer because it has the potential to replace human intelligence. In fact, Wiener said that he thought that he didn't know what is more dangerous, the atom bomb or the computer. That was just a couple of years after the Hiroshima and Nagasaki disasters. But it's true, if computers are replacing many kinds of things that people are skilled to do, that's an issue. We don't know where it's going to go, and that doesn't necessarily have to work out that way, but I think it's a risk that we'll see greater inequality in 10, 20, 30, 50, 100 years. And we have to think, I think we should think about, this one thing that I said in my recent books, we should be thinking about this now, not wait until after it happens, even though we don't know that it's going to get worse. So here's where I think finance training helps me. It's a risk. It's certainly a risk that this trend is going to get much worse. You'd hardly hear people discussing that, but what we're supposed to be trained to do in finance is to think about risks and how to manage them. And there are tools for risk management. So in particular, I've advocated, and actually this was picked up by Ian Ayres at the Yale Law School in a New York Times column he wrote, but he and I are both advocating that we have a contingency plan in place now to raise taxes on the rich if inequality gets worse. They won't like it, but I'll tell you, they'll accept it much more willingly if it's done in advance as a contingency plan than if we wait until it happens and then try to fix it. Yes? Well, I was getting out of the shower this morning. I wasn't properly dressed, but I didn't want to miss the phone call, so I took it. In our kitchen, that's where I was. Yeah, it was quite a surprise when it happened. I certainly didn't expect it. Oh, I called my brother, yeah. Well, I thought my brother sleeps in, and he might actually not know in Detroit. So I called him, and I said, "Did you hear the news?" And he says, "The Tigers lost." Everyone else called me. That's the only person I called, my brother. Yes? Mm-hmm. Right. Well, you mentioned two things, the stock market and the housing market. Yeah, it's true the Fed has embarked on the most expansionary monetary policy ever. It's not just low interest rate. Well, the interest rates have been at virtually zero, and on top of that, quantitative easing that's caused the Fed to raise their balance sheet up to almost $4 trillion. That's more than 4 times bigger than it was before this crisis. So it's very aggressive, and it's not surprising it would have effects. The stock market is rather highly priced, and there's different ways of metric. I know this is controversial, but work that I've done with John Campbell and we've developed a price-earnings ratio called CAPE, or cyclically adjusted price-earnings ratio, that is standing now around 24, which I think is high, but not as high as it was in 2000 when I published my book, Irrational Exuberance. It was 46 then, almost twice as high as it is now. So I don't think that one should view it with alarm, and one could well invest, and probably should in a diversified portfolio, invest in stocks. But I worry that it might correct down. It's not a sure thing at this point. The second thing is the housing market. Housing has corrected down in real terms from its peak, according to the S&P Case-Shiller Index, by almost 50% since its peak in 2006. And it's up now. It's up about 18% in real terms from the bottom in March of 2012. So it appears to be correcting up. The question is whether it's a new boom or even a new bubble. I think this is still an unanswered question. The interesting thing is that bubbles in the housing market, or bubble-like phenomena, are not confined to the US. And in fact, we have what people call real estate bubbles in lots of countries now. Like for example, China, Taiwan, Hong Kong, Australia, New Zealand, India, where am I going? Belgium, Norway, UK, United States, Canada, Mexico, Brazil, Chile. I might have left out somebody, but that's my list of countries. Now, I don't necessarily know that those are bubbles, but I'm just saying that people in those countries say that. So it's happening in so many places. It's hard to understand all of these phenomena. What I think is that after the financial crisis, or starting around 2000, before the financial crisis, the world became more speculative about real estate. It used to be not considered something to worry about, home price, unless you lived in Manhattan or a rare, unusual place, or London, place like that. But now people worry everywhere. It's a cultural change that I think will tend to bring volatility for years to come. And I think it's a suitable function of central banks to try to lean against this volatility, which they're starting to do. We have to consider that. But it's a psychological change or a sociological change that. On the other hand, let me just say about the United States, home prices are not high yet here. They've got a long way to go before they're like they were in 2006. I do, with the support of the Yale School of Management, I do survey. We just did a survey of home buyers and asked them their expectations for home prices. And depending on how you quantify or summarize their expectations, it seems that Americans today who've just bought a house are thinking that the home market will be back up to its 2006 peak sometime in the 2030s or 2040s. I'm reporting what they say. Home buyers are not excitedly optimistic about the longer run. They think in the short run they're going up, but they think that it might be just a rebound. And there's so many things to say. Also, the advent of professional investors like Blackstone Group, which now owns 36,000 homes. We're seeing more professional involvement. It reflects a change in the market. It's not clear that it's the same thing that was happening 8 years ago when we saw the housing market booming. I'd say it's probably not the same thing. It has a different outlook, not so optimistic for home buyers. Yeah. He asked whether the financial crisis adequately addressed. That is, I tend to take a very long historical sweep on these things. History of the past centuries has been a history of repeated financial crises and repeated advances made in response to these crises. So, for example, the Federal Reserve Act of 1913 was substantially a reaction to the panic of 1907. And then the Securities and Exchange Commission was a result of the 1929 stock market crash. A few years later, it doesn't happen immediately. And then this financial crisis has given us the Consumer Financial Protection Bureau. They're all steps forward. That seems to be the way financial progress is made. It's slow and incremental, and then there's a crisis, and then people are willing to think about fundamental changes. The Dodd-Frank Act in the United States is the big thing, and it has done a number of good things, but I think there's a lot more to do. So I suggest you read my book, New Financial Order, in 2003, or my book, Subprime Solution, in 2008. I think there's a lot more that we can do, and it will help make a better society. But some of the things that I talked about in this book, these books, I should say have actually happened. In fact, President Obama, several years ago, announced a student loan program that has income-based repayment. That's progress. That's financial progress. Now, and it's starting in a small way, but it goes back to something that was started here at Yale under James Tobin in the 1970s. Yale University started a income contingent student loan program. Right now, there's another little crisis, not so little, in student loans. It's a follow-on to the financial crisis that a lot of people are having trouble repaying their student loans. The Yale Law School has had a COPE program, so-called, that has student loans that are tied to subsequent income. So we're seeing, I think this is a source of pride for Yale to have been at the very grounding of these. So I advocated these kinds of things again in my book. And now we have President Obama proudly describing these things in his speeches. They're happening, but still not big enough. I think we have to have more flexible financial contracts that are more responsive to people's needs.
I think we could take one more question, and then we'll have to let you all go. Yes, one more.
Do you have any policy recommendations for
So he's asking what my policy recommendations for Janet Yellen are. Well, first of all, I've looked at some of her recent speeches and read them carefully. And I just am very impressed with her good sense and her recognition of the important issues. So I would probably not presume to tell her what to do. That she has been she's been the chairman of the Council of Economic Advisors under Clinton, and then president of the Federal Reserve Bank of San Francisco, and then vice president. I think she has a lot of expertise. But you know, I could just say general things that someone in her position has to look at the welfare of everyone. I don't think I have to tell her this, that I think that she views her job correctly as a steward of our nation, and that means considering how economic conditions could harm any of a number of subgroups. So we have the risk of unemployment, which is still with us. We still have, we don't know what it is at the moment because of the government shutdown, but it's something probably over 7% unemployment. That's terrible for the people who don't have jobs. This is the thing I remember hearing Tobin, my mentor here at Yale, say, that it's real suffering, it's real problems, that it's not just a statistic. On the other hand, though, if we become too loose in our monetary policy and bring on inflation, that will hurt somebody else. The elderly, for example, who are living on fixed incomes could be seriously harmed by an outbreak of inflation. So I think that one reason why I've been such a strong supporter of Janet for this position is that I think her heart is in the right place and she's observant about people.
Thank you all very
Okay.
much.